we need to talk about China. Now, the Chinese system has been crappy and getting crappier for a very long period of time. We're all well aware of that. However, something abruptly changed this summer. It's as if everything has been taken up a notch. Bank lending contracted at the worst rate in over 20 years. Household loans fell up $500 billion. Industrial production slowed way down. Consumer spending fell off and contracted for 2 months running for the first time since early 2020. Fixed asset investment in China absolutely plunged this summer. And just as bad, Chinese stocks are soaring. Those have the look and the feel of an artificial trend that's been put together to put a positive spin on what is turning out to be a significant deterioration in circumstances. It's very reminiscent of 2015, right before the crash in Chinese stocks and the hard downshift in China's economy that rippled throughout so much of the world and wrecked so much of the emerging world. And remember, too, where it comes to China and Beijing, we're now 11 months after the big bazooka policies from last September. The Chinese government has been implementing those ideas and then some. It has borrowed a staggering sum by issuing all of these government bonds. I told you back then it wouldn't work, and it has stunningly failed, as all government stimulus policies do. But this goes beyond the usual failures. It's not just that stimulus has failed to stimulate in China. There's a big-time stumble going on this summer, which will ripple all throughout the rest of the world as if something massive has shifted, more than it had before. Call it payback panda. The usual, normal, what we've become accustomed to deterioration in the Chinese economy and its banking sector has abruptly shifted, downshifted to the downside, starting around June and heading into July. That's what all the latest economic data says. That's what the banking sector statistics all say. And it's also what we're getting from China's oil sector and the results from Sinopec. China's big oil company reported operating income that dropped 10.6% in the first half of 2025 compared to the first half of 2024. Its profits before tax crashed by 43.4%. And net income fell 36% to 23.75 billion yuan. And the company also said, as a result of all of these results, it's going to lower its full-year capital spending plan by around 5%, a perfect representation and illustration of the struggles in China's economy that become further problems down the road. Less investment, less of everything else. As Bloomberg reported yesterday, Sinopec has been contending with a number of challenges this year. The company's reported lower production of both gasoline and diesel, as they have to put this in here. The rapid spread of electric vehicles has undermined demand for the transport fuels. However, at the same time, the industry has been grappling with overcapacity and intense competition, with Beijing expected to tighten controls over inefficient refiners. Oversupply simply means under demand, recessionary types of conditions. Deflation that's coming from the energy space is a natural and direct reflection of that falling demand, not necessarily increasing supply, especially in China, where the overall supply is an external variable. And while the media loves to talk about the widespread adoption of EVs as the reason for lower oil demand, especially in China, and that's true, it has put a dent in it, the real dent comes from the other part. Industry grappling with overcapacity, because industry China-wide has been suffering from the same thing. Overcapacity that wasn't overcapacity until very recently. Just look at the retail sales data for under demand in China, like we'll do a little bit further on here. There wasn't supposed to be overcapacity when the capacity was first installed. There never is. That's the nature of any business cycle. And while this is a unique cycle in many ways, at the fundamental level, it still is a cycle. Forgot how to grow remains the downside to it. Only now in China, forgot how to grow has shown concrete signs of remembering a lot worse, especially the last couple months that we're getting here. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. What the Chinese have tried to do in the 21st century is use those unique circumstances to their advantage. Xi Jinping really believed that the recovery following the lockdowns was legitimately robust. And most of all, China would benefit the most from it, more than anywhere else. So Xi intended to leverage that upswell to finally deal with the festering real estate bust, the same one which was created almost 2 decades ago as a transitory response to the Great Not Recession, which instead became the Silent Depression rather than a recovery. And this is, you'll notice, a persistent theme. False dawns, recoveries that are promised but never delivered. And as the global recovery in the 2010s wore on, the Chinese built more properties as a way to sustain the previous model of socialism with Chinese characteristics. But in 2016 or thereabouts, Xi Jinping decided he'd seen enough. And he began to curtail the temporary Keynesian stimulus, quote unquote, that had only stimulated the massive property bubble, not the actual economy, which only grew worse throughout the decade. The pandemic, therefore, seemed to offer a unique opportunity. The massive recovery, or what everyone believed was a recovery, gave Xi an out. Leveraging the economic gains or purported economic gains or expected economic gains to offset the drag from the property bust, creating new avenues for economic activity, employment, and advance, while also giving, importantly, banks a way to profit on the real economy so that they could offset those legacy real estate loan losses. And it was a genius idea, or so it seemed. The problem in China is everywhere else. It was all based on an illusion, a lie, not a real recovery. Global prices soared not because the global economy did as it recovered. Prices soared because there were too many negatives on the supply side, so surprising less upside in demand was all it took to trigger basic economics, the price illusion. Now, the reality of the situation became painfully clear in early 2023, reopening. China had locked down the year before, and when they opened back up, it was supposed to be this renaissance, that China was going to lead the rest of the world into an actual global recovery, and instead, China face-planted. That wasn't just a warning to Beijing, it was an unmistakable signal just how embedded Forgot How to Grow was going to be, because there was no recovery, only the price illusion. And ever since that shock, the shock to economists and politicians, not to the markets, by the way, but ever since that shock, the Chinese have been ramping up more and more quote-unquote stimulus over everything from housing rescues to historic housing rescues, fiscal spending on waste, then the massive 2024 bazooka, more subsidies, a bank recapitalization plan, almost everything you can imagine. And China's economy has only gotten worse. At best, it has been unresponsible. But the worsening thus far has been slow, almost imperceptible, especially after we get normalized to it, totally in keeping with the Forgot How to Grow mode. But the next warning sign came last year, that global inflection that we keep talking about. In China, the Chinese banking sector started to accelerate its own decline. Bank lending was negatively impacted by the failure of the economy after reopening, since reopening was supposed to provide an out for banks to generate more than enough accounting profits to offset those mounting property loan losses. They could effectively clean up their balance sheets by scraping some of the booming recovery to pay for it. Take away the boom, China's banks are not just left with those prior losses, they now have to deal with overly leveraged real economy firms who are suddenly getting to be almost as risky as property developers have been. No wonder loan growth just fell off. The total outstanding stock of loans was growing at around 11% in 2022, which is already a much slower rate than before the 2020s. It temporarily jumped up to around a very nearly 12% in early 2023's reopening, but then quickly faded during the troubled summer. And by March of 2024, that global inflection, the rate was under 10% for the first time ever. But it was below 9% just 3 months later, and at 7.7% year over year in November, 2 months after the bazooka. As of the latest figures released for July, outstanding loan growth is 6.9%, below 7% for the first time ever, and continuing to slow at a staggering second-order rate, a drastically slower rate of growth. And this simply means that Chinese banks are increasingly only lending to their best and safest borrowers at the expense of everyone and everything else. That also means household and corporate loans. Now, Chinese government, they've been targeting specifically mortgages and households as a way to try to kickstart the moribund property sector. And it has not worked either. The PBOC, for example, has lowered its policy rates, which do have a more direct impact on mortgages in China, especially those that are tied to the 5-year loan prime rate. And there have been targeted programs to ease the way for first-time home buyers, even the relaxation of restrictions where it comes to second home buyers and investment properties. But China's bank credit stats show nothing has worked. In July, the latest data that we just got, new household loans crashed by $500 billion, more than double the drop of July 2024, which had gone a long way to convincing Beijing the government needed to amplify and accelerate its housing stimulus, which the bazooka, it did. And as you can clearly see, no effect. Stimulus doesn't stimulate, especially lower interest rates. As always, lower policy rates and ramping up fiscal expansion, they're always instead a response to the weakness, not a solution for it. And going beyond lending to households, though, Chinese banks are just cutting back everywhere. New RMB loans described by Total Social Financing, those also crashed unusually in July. Now, July is not a top month for lending anyway, coming after June when banks and borrowers have to meet quotas or at the very least secret minimums. Yet this July was something new, something else. New RMB loans dropped by over 400 billion, the worst in any July or any month for that matter, in over 20 years of figures. These estimates show that not only is the banking situation getting worse, it is indeed accelerating, and moreover, it does appear to be finally having an accelerating downside impact on China's economy. Now, the one thing that China did do was in response to this increasingly downside to the Chinese banking side, the increasing Japanification of Chinese banks, they issued the bazooka, they announced the bazooka, said they were going to borrow a ton of bonds, and borrow a ton of bonds, they did. So Beijing has at least lived up to that end of it. They've been issuing bonds like crazy. In fact, according to Total Social Financing, government bond issuance has been gigantic since last August when the big stuff got ramped up. New government bond financings just in the first 7 months of this year have been 8.9 trillion yuan. That compares to 4 trillion January to July 2024. Now, according to mainstream economics, the Keynesian version, that massive government impulse should be more than enough to offset and overcome the downside from banks and the real economy's long-standing problems. To Keynesians, it's all just aggregate demand, but the world does not work like Keynesians assume it does. China is the perfect test case for every last one of their theories. And not only do they fail every single time, they do so in spectacularly obvious fashion. Now, the downside in bank lending and the slow decline in the real economy, which goes along with it, they've been building and building the past year or so. Now, here in the summer of 2025, it seems to have finally broken out to an even greater downside. Part of it is just the strain from all that, but also China is suffering from economic payback too. Having ramped up to a certain degree, producing as many goods as possible to beat tariffs, there's now the negative pull of the aftermath. I mean, if you front load demand, there is going to be payback to it. But that's just one more negative factor to add to all of these others. And the stats really tell the tale. Now, industrial production for the month of July has only moderated here in the summer, with the July growth rate coming back down to around 5.7% year over year from 6.8% in June, having been as high as 7.7% back in March. So payback in industry has been coming on more incrementally. Retail sales, on the other hand, there's been a clear trend change with those. I mean, you could argue the bazooka had some at least short run effect on consumer spending, maybe a small acceleration in retail sales last year and perhaps to the start of this year. But it really changed in March, just like everywhere else around the world. For the monthly data from the Chinese government, retail sales slowed to just 0.2% month over month in March, then 0.16% month over month in April. Now, retail sales shot back up by almost 0.6% in May, but that was entirely due to more government stimulus, this time subsidies for items like appliances or consumer electronics. And all that did, as usual, was pull forward demand, leaving the consumer economy in China to suffer its own government-induced short-run payback, which is, of course, exactly what we see, shocking only economists and communists who, in the Keynesian variety, aren't all that far apart. Retail sales outright declined. They outright declined by 0.26% in June, a big shift, and then another decline, 0.14% in July. These are the worst months for retail sales in China since the end of 2022, the zero COVID lockdowns, if you can believe that. Given everything here, it's not that hard to believe. It does look like, and the evidence does point to more and more, that China's economy has hit that air pocket here in the early summer of 2025. Maybe the most convincing and compelling evidence for it comes from fixed asset investment. FAI used to be the basis for China's miracle, which wasn't actually a miracle. It was just basic economics of the Eurodollar's heyday. China was transformed by becoming the factory to the world, which meant creating not just the factories from scratch, also the houses for the cheap workers where they were going to live, the roads they used to drive to work and drive factory produce to foreign markets, the ports to ship everything out, and a whole lot more in between. All of that, fixed asset investment. And FAI was steady to slightly higher at the start of this year, in large part from the government deploying some of the proceeds of all that bond borrowing. But as you can see, that quickly dissipated. Over the last couple months, though, June and July, we've got the same degree of something bigger happening, a contraction. FAI has fallen off sharply. The accumulated year-to-date rate went from 3.7% in May, which wasn't great, to 2.8% in June, so already a big drop for an accumulated rate to make in just a single month. But then it fell to just 1.6% here in July. Private FAI went from slightly positive, being still dragged down by the property sector, to minus 1.5% accumulated last month. Even state-owned FAI has dropped off sharply. In making some of my own back-of-the-envelope calculations, looking at FAI in single months rather than on an accumulated basis, private FAI must have been falling at something like a minus 7% year-over-year rate in July, one of the worst months since the first couple of months of 2020. It's not overcapacity, it is under demand. It is the lack of recovery. It is the lie that follows the price illusion. China was going along, it forgot how to grow, already not good, and now all the signs show it is suddenly remembering how to do a lot worse. And that is reflected in all of these deflationary signals we get all over China's economy, in producer prices, in GDP deflators, even in wage indications. The Chinese have been trying to hold everything together just long enough for a miracle, another miracle to happen, for the global economy to legitimately pick up enough to keep China's macro and banking decline more manageable and within acceptable tolerances. And since that didn't happen, the entire world went from forgot how to grow to forgot more how to grow last year. The government has tried to step in to stabilize everything in China with a massive fiscal push, which clearly hasn't worked. But now with all of these negatives piling up, this summer China went from not working to holy crap in all these various ways. FAI and key investments were dropping sharply, consumer spending already weak, now paying back the distortions, industry slowing, bank lending just contracting. The only thing which does appear to be working is China's stock market. But in the same way Chinese stocks seem to be working and optimistic back in 2014 and 2015, right before the crash and the permanent shift in China and the global economy. Money in China, savings in China, have nowhere else to go. They can't go into the property sector or real estate. They sure can't go anyplace in the real economy. So everyone is looking for some shelter, and with state support that appears to be working at the very least in the stock market, everyone is piling into Chinese stocks. So Beijing's efforts to prop up equities, which go back to January of 2024, have for the time being appeared successful. Everyone is naturally piled into the shares since there are no other options, and since government support has appeared to work, it gives everyone a rationalization. Stocks are the least worst option in a country which does look like it may have run out of options. Now, China has been a mess for well over a decade, and everyone knows it, including Xi Jinping. That mess has gotten clearly worse the past couple of years, ever since reopening failed in early 2023. Again, Beijing is well aware. That's why it's ramped up all this stimulus on all these different fronts. What we're seeing in the summer of 2025, however, goes way beyond the usual failed fiscal or even just the normal deterioration. Something on the downside has gone into overdrive, especially June and July. Trade wars, trade sentiment, both of those combined with banks that are reaching a possible credit crisis cliff, something has changed. So we need to pay attention to China. And the fact that stocks are soaring is ironically the last signal to that same effect. Our forgot how to grow world really does appear to have remembered how to do worse, especially where it comes to China. And China, as you'll note, that's a big one. After months and months of warning about the possibility of tariff inflation, Fed Chair Jay Powell says, well, we don't have any evidence for that. I'm now starting to worry about the labor market situation in the US too. Jackson Hole went over the details plus what people missed about it in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.